I want to thank you for, whoops. Hang on one second, I have a slight problem here. Start broadcast.
The broadcast is now starting. All attendees are in listen-only mode.
I want to thank everyone for coming to this webinar from Trend Following Mentor. This is Andrew Abraham, and we're going to discuss some issues that's happening in the market. And really where I want to start off is that people are either bears or people are bulls. Well, if you're a trend follower, you shouldn't be either one of them. What does that really mean is you should let the market tell you what it's doing, and we have to react to it. That's level one. But then also we have to be cognizant of really what's happening around us in the market. And we're going to talk about three issues. I'm going to talk about the S&P 500, the stock market. Then I'm going to talk about Apple, which many people are interested in. And I'm going to talk about the Eurodollar. So when we first start talking about the S&P 500, I'm going to just pull up something on the blog that came up the other day. That the fact is like this: in the stock market, you have a certain duration of time of bull markets and bear markets. And most, let's say, bull markets, they last for on average, let's say, plus minus 4 years. So if we really want to be cognizant of where we are in the situation, bear that in mind. But the thing is, let the market, again, let us know what we should be doing. And we have rules, and I'm going to share you these rules, because what we do as a trend follower is that we have a complete plan that tells us what to buy, when to be in the market, how much to buy, and then when to exit without exit with a profit or exit with a loss. So one thing I just want to point out, whenever you have these covers on Barron's magazine, proverbially, when they're very bullish, you should almost take it as bearish, and vice versa. That's issue one, and I already said just about the average duration. So let's jump and let's look at a chart of the S&P 500. Let me just shift this a little bit. Very simple rules. Before we determine what stocks we should be in, the basic premise when we are trading stocks is we want to buy the strongest, we want to sell the weakest. Pretty logical. Great. But then the other rule is, should we be in the stock market or should we not be in the stock market? And let me say it like this. As a trend follower, it doesn't matter if whatever market we're trading. We can trade stocks, we can trade currencies, we can trade commodities. None of it matters. Inflation, deflation, bull market, bear market, none of it matters. And the time frame doesn't matter either. You can do 5-minute bars, you can do hourly bars. It really doesn't matter. But it has to match your personality. The first thing is, to me, it's more difficult to do intraday type of trading. So I look at dailies. This way I can get my work done very quickly and easily in the morning, and I'm done. So before we determine if we want to be in the market, we use some simple rules. And very simple. There's a line. There's a 200-day exponential moving average. And as you see, I use Metastock. Most charting programs have charting capabilities. If you're above a 200-day moving average, you can say the coast is clear. Another interesting line of demarcation is a 50-day moving average, which you can see we hit a couple days ago and bounced off of so far. But I like using something else that's also pretty cool. And it's a little bit tighter, and everything in trading has an advantage and a disadvantage. Sometimes you'll get whipped around a little bit. Sometimes you'll lock in your profits. So one simple idea is use a 10-period exponential moving average, which is this blue line here. You can see it right there. And I have a 30-period exponential moving average right there. And basically, if the 10 is greater than the 30, you have the all clear sign. And you're going to be giving back less when it changes, but you'll get whipped around at points. So where do we stand right now? It looked like we were falling out of bed. All of this, what's the guy's name? Mario Draghi, if I'm pronouncing his name right, we had these big moves up. Basically, we came right back to them, where he promised to bail out the euro and do whatever it takes. And he mentioned he was going to be buying bonds. Well, we gave all that back. And now what we're seeing is, so far, and again, you have to take it day by day, and again, let the market tell us what to do. Not that I'm a bull, I'm a bear, and I'm married to that fact, because that's only a way that you're going to lose money. So the fact is, right now, you can see the 10 period is above the 30. You should be long the stock market. But you should be a little bit wary. One is because the age of this bull market. One is that also that I talk about a lot too is, I want to try to move this, you can see with an MACD, you can see where the prior highs are. And what's happening is you see this prior, let me shift this over. I don't think you guys see it, but I see it. You have higher highs here, and they don't confirm here. You have a lower high, higher high, higher high, lower high. When you have that, it's like an X-ray in the market. And the market is saying internally, it's not that strong. And even if you were to look at, let's move this down slightly, which it's not letting me, that's great. Let's move it up a little bit. You can see, it's not letting me do it. Basically, you have another dichotomy again. You have higher here, and you're lower here, yet you're higher here. So internally, the market is weak. I want to jump to another issue. When you have a green light to be in the market, like you have all of this period, and you have all of this period here, it's a nice chunk. It's a lot of nice months. What we do is we go in here, we rank the markets. And what you do is you want to buy the strongest, and if you want to go short, you can sell the weakest. But I want to say something. The other issue, too, is you make most of your money is coming out of quiet markets and on the long side, not the short side. So have a bias a little bit to the long side. And even in my own trading on the stock market, I don't really like going short. I like going long. There's more upside, and there's a lot more potential. So again, what we do is, first of all, we say, can we be in the market or can we not be in the market? And right now, you can say we should be in the market, but a little bit cautious. Maybe, again, you need to figure out rules that match your personality. I have my rules, and when you're one of my students, I give you all my rules. And then if you want to be one of my private students doing private mentoring, I help you build your own plan. But then what we do is we rank the markets from weakest to strongest. And then, obviously, you want to buy the strongest markets if you can put on a low-risk bet. A low-risk bet is very simple. What does that mean? What I suggest, again, it all is going to boil down to you again, is that you risk no more than 1% of your account size on a trade. For example, let's say your account is worth, you have a $100,000 account size. 1% of your account size is $1,000. You don't want to risk more than $1,000 on any trade. And what you're going to do is measure. And again, one of my tools I believe in is using a Donchian breakout, where you can look at the 20-day high and the 10-day low. It worked for Richard Donchian, and he did it for something close to 50 years. And if it worked for him, it'll work for, it's working for me. It'll work for you as long as you're consistent. So you measure the distance from the 20-day high to the 10-day low, and you figure out the difference. Let's say hypothetically, it's 5 points, hypothetically. And your account is $100,000, and you're willing to risk 1%. You're willing to risk $1,000, so you can put on 200 shares of whatever, let's say XYZ stock. And let's say the distance was $2 from the 20-day high to the 10-day low. Then you can put on 500 shares. So this is the concept or the basic idea. I want to jump over to Apple. Hopefully this will work. Here we go. And as an example, and I posted this actually on YouTube a couple of weeks ago. And it was interesting what I discussed. You had a buy signal again because you ran up from these lows, and you had a buy signal, and Apple was one of the strongest stocks again, believe it or not. So you had a buy signal, a breakout signal. And you had a nice little run, and everyone was all ecstatic because Apple went to 700-ish. And then it fell out. The way we determine to be in the trade or not in the trade, or when to exit, excuse me, with a profit or a loss, very simple again, is I have two ways. It's an average true range trailing stop, which you can see here. Or I have this. I wrote an article in Stocks and Commodities magazine called Trading the Trend, which is this one. Either one of them, they tell you when to stay in the trade and when to get out of the trade. Pretty simple. And let me just kind of shift this over here. We had a very big trade here. And then here's your exit point. Thank you. Out. The mistake traders make is they don't follow the rules. They didn't exit when they should have exited. And that's what you need to have in a complete set of rules that tells you what to buy, and our rate of change here tells us what to buy, or relative strength. Then we want to say, can we be in the market or not in the market? We want to buy the strongest if we can put on a low-risk bet. We have other risk filters, too, that I teach. And then if the trade is working, you follow it. And if it's not working, you get out. If you start second-guessing yourself, you're going to lose money. You need to be consistent. But what's interesting here, again, look at this highs here. And then look at the highs here. On the MACD again, you had a dichotomy. You have internal weakness in the MACD. So you had a divergence. You have lower highs, higher highs, lower highs. It's a signal to tighten up your stops. You're just got to be a little bit careful of what's going on. And now, for those that were so intrigued and they watched the video on YouTube, I don't know if they exited or they didn't exit, but you know what? You had a nice little run. You could have gotten in about here-ish. I think it was this bar if I'm not exact. And then, okay, had a little profit. Nothing to write home about. Maybe 10 points, 10%. But so what? It adds up. Because what happens in trading, only basically four things. Big losses, small profits, big profits. Your job, if you plan on being and doing trading and trend following for the next however long you're living, because trend following to me is a lifetime strategy, you have to avoid the big losses. And if you don't avoid the big losses, they can be lethal to you. So you need to follow a plan and never second guess yourself, because no one knows anything more than you know. Let's do another chart, and then I'm available for some questions. Let me open up a chart on the Eurodollar. Well, here, I'll just do it quicker this way. Futures. 1 second. Let's get rid of this, and let's get rid of this. What's very interesting, talking about the Eurodollar, everyone hated the Eurodollar. Everyone thought it was going to crash. And you know, it had a big down move. But what happened here? Look at what's happening here. Fascinating. Again, when we're talking about this, MACD, you have a divergence. Lower, 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 higher. You had a divergence here. So what you would do if you were trading currencies, this would be a little bit of a wake-up call. Say, wow, maybe the Eurodollar isn't as weak as everyone's saying it is. Then you would do basically a ranking. You'd rank all your currencies, whatever currencies you're trading, determine which are the strongest and which are the weakest. And you know what? I would be willing to bet you that the Eurodollar was one of the strongest. So what you do, I believe this is the 50 period moving average. you'd see if you have, you'd see if you had a breakout, which you probably have a breakout out here is an assumption. And then you follow this trade, and you'd see what's happening. There's no rocket science to any of this. What we do is we combine simple trend following ideas into an exact plan. But that's only part of it. The big issue is the psychology of trading. How do you feel after you've had 3 trades, 4 trades, 5 trades, 8 trades in a row that don't work? Because I'm going to tell you something. It's going to happen. It happens to me. And the analogy is, this is a marathon. It's like, imagine this is a football game. I'm saying a U.S. football team, let's say. You get knocked down. How many times does the quarterback get knocked down or sacked or hit? But you know what he does? He gets back up. If you want to be a successful trader, you trade with a plan. You trade with risk management and money management. That you have exactly, you know what you're risking. And you don't go with the assumption that the trade has to work. You have to go with the assumption any trade is 50-50. And I say to myself, how much is it going to cost me to see if it will work? And I'm risking anywhere between, I have 3 programs that I run. I have a low volatility program, a mid volatility, and a high volatility called Formula 72 Low, Formula 72 Mid-Size, and then Formula 72 High, where I'm risking anywhere from 50 basis points to a maximum of 1.25% of my account size. I accept the risks. I believe that the trade is 50-50. I believe that anything can happen and anything will happen. Again, who would have believed that the euro-dollar would turn around? Successful traders would. You can learn this. The idea is, don't have an opinion. Let me just see what one of this question is. What force index tell you on the currency chart? Okay, that's a whole nother discussion that I didn't know if we really had time to get into, but let me just give you this quick point. There's 2 ways I work. And very basic. One is a breakout trade, Richard Dawkins type of breakout trade, where it goes through a conveyor belt of yes and no. Did this happen? Yes. Then it goes to the next level. Is this happening? Yes. This happened? Yes. And it goes through all these yes, no's until you can say, yes, I can take this trade. And that's one level. Then the other level is you buy retracements. And you can see on here, let's say you missed this. Okay, you had a nice, let's say you're supposed to have been long already. The force index right here tells you when you have a pullback in an uptrend where you can see, I'm going to make it a little bit easier. Let me move this thing over. Right here. Here's an entry point. And it would have been this bar. Again, what you're doing is you're buying the high of this bar. You didn't get hit. Then you go to the next bar, and you'll be buying on this bar. And right now you'd be thinking, okay, great, I'm kind of smart that I bought it, let's say 129.70, and we're at 131.36-ish. You know, so it's nice money. That's how the force index works. It's not rocket science either. Nothing is rocket science. Actually, the only thing that can hold up over time are very simple, robust ideas. And then the key point comes down to is adding the risk management. These are the most important issues alongside the way you think. And if you want to win in trading and compound money, you have to have this winning attitude. You have to be committed. You have to follow the rules. We're talking about sports again. That if you don't follow the rules in any sport, if it's football, soccer, they basically put you time out or throw you out of the game. It's the same thing, the rules with trading. You have to develop a set of rules. I have an explicit set of rules that I've done over the last 18 years. And it's been a work in progress where I've seen things, I've realized things, and my trading and my plan has been enhanced. And the best point is you have a choice. You can learn from your own mistakes. You can learn from mistakes from other people, which That's what I try to do. And the fact is, putting it all together, it's like it's easy to think that these indicators are the answer. They're not. And many times, I don't even say many, I say the vast majority of the times, people put all their time and emphasis on finding entry indicators. It means nothing. It means nothing. You need to know how much to put on. You need to know where to get out with a profit or a loss. You need to be able to think clearly on every trade and realize that each trade is statistically independent from the last trade. Has nothing to do with that last trade. And you might have to take 2 times to get into the trade that ends up being the winner of the year. Because the winner of the year. Let me clarify this also. For those of you that haven't read my blog or haven't subscribed or bought one of the courses or the book, there's only 4 things that can happen. Big losses. Your job is to prevent big losses by putting stops in immediately in the market. But I want you to understand something. Markets can gap, like we have this year. Let's go look at this Apple chart again. You have gaps here. Imagine the people that were short here in the 550s, and then it jumped up to, let's say, the $600 range. It can happen. It will happen. The other issue, too, is when you're trading futures, you have limit moves, and you cannot get out. So these things can hurt you, but you can't stop quitting. You can't stop trading. The other reality is you're going to have tons and tons of small little trades that don't work, and you have small losses. But that's okay. You leave your money as inventory to partake in the upcoming trade. The other next thing is don't get carried away. When you have a trade that works slightly, big deal, it worked. Because then the other thing that's going to happen is a rare amount of time, very infrequently, let's say out of my trading after 100 trades in a year, I might have 3, 4, 5 big winners that make up for the whole year. Like something like this. This was a massive move, depending on how many shares you could put on. Because that's also the key. It's position sizing. Anyway, if there's questions, I invite you to post your questions. And for those that are listening, I just want to tell 2 things. That if you want, you can email me. I have a free 40-page ebook that I will gladly send you, or you can just go to, you just go right here. It's easy. Let's go back a sec. Also, you can come to the blog. Every day I try to post something that you'll learn about trading to enhance your trading. And right here, there's a little box. You sign up, and then you get the 40-page book. And then every couple days, every once in a week, whatever, I shoot out some information that you might find interesting, like on the blog, or it might be another YouTube video. Then the other thing I want to point out is what really is our goal in trading? Unfortunately, there are people that I've taught that think this is Las Vegas. They're looking for excitement. They're looking for fun. They're bored. They're just looking for something. That's not what it's about. Really what it's about is compounding money. And I want to share with you a story that, let me just find it real quick, and I can email it to you too. 1 second. I'm going to actually open it. One sec. Basically, in this book, and it's talking about managed futures, it's from Marhedge. On page 3, oops, it's not responding. That's great. Okay, now it's responding. Oh, maybe it's page, 1 second, page 3. Yep. And I invite you to read this, that a man invested, first of all, let me just give you a quick idea. Hawksbill is, actually he was one of the turtles, and from 1988 to 2003, you can see these are his returns, but his first investor in 1988 invested $300,000. He took out $1 million, and in 2003, it turned into $18 million. Figure another 10 years of compounding. This became something like $30 million. I'll gladly email you this. It's doable. If this investor can do it, you can do it. It's doable. But I also want to point out like this, that Hawksbill, one of the turtles, it wasn't easy. There's nothing easy about trading. He had a lot of drawdowns. He had, here, let's, down 29%, down 27%, down 25%. His worth drawdown, if I'm not mistaken, was something pushing the 50-60% range at one point. But the fact is, Hawksbill didn't give up. This investor didn't give up. Trend following is not easy. It's not for everybody. But if you can have a plan that fits your personality, that you have strong risk management in there, and that you can follow the plan and you have this winning trading psychology, you stand the potential. And it is a potential because we don't know what's going to happen in the future. And because what happened here doesn't mean it'll happen to you. And this is not representative of every CTA or every trend follower. I mean, he's an exception. He's good because he gets it. He knows what it's, he has the winning attitude, I think, also, besides having this magical system. I don't think there's any magical system. There isn't. Simple works, robust works, but you can create extreme wealth. Let me jump to this question. Oh, we have a couple questions here. Any recommendations on what works best on trend following, hourly charts and currencies? Sorry to tell you, you'll never, ever find what works best. There is never what works best. What works best is something that you can follow and that you believe in and that is simple and robust, that works on all time frames and all markets. So there is no such thing as a best. Okay? It has to fit your personality. Let's see if there's another question. I think there was another question. Let's see. Again, breakout or retracement entry is best. There is no best. Sorry to tell you, when you're asking for the best, really what you're asking for is how to avoid losing trades. It doesn't exist. You need to basically accept the risk in the market. Let's say if it's here and you're going to go to the 10-day low, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, you say from here to here, I'm willing to risk that money. I'm willing to put that money up on the table and see what happens. And if I'm not, then you know what, reality, you shouldn't be taking that trade. So that's what it really becomes. A robust methodology, risk management, every potential outcome pre-thought out, nothing left to chance. Then you have to make sure that you can follow that exact plan. And that's why I call it trendfollowingmentor.com, because you know what? There's people, very simple system, they can use it. It can be written on the back of a business card how to do this. And actually it is written on the back of my business card. Back of my business card says, I'm looking at it, trade with the trend, cut your losses, let your profits run, and don't let the big profits get away. Well, it's pretty simple, but if it was so simple, why isn't everybody making money? And the reality is because they don't have the mental trading psychology and they don't have the risk measures in place. This is the concept. This is what separates a struggling trader and a successful trader. Let me see if there's any more questions, and I'm going back to work. And hopefully this was helpful to you. Hold on. Let's see. What should I do to figure out what kind of trader I am to see what methodology I should use? Okay, good question. But what you have to say to yourself is, what are your time constraints? You cannot be a day trader if you have a full-time job. And I mean, again, it's very emotionally tough. And if you want, you can email me and we can chat about it and I can kind of direct you a little bit. To me, what works for me is I like doing daily charts because I do a lot of research because I want to have a world-class system for my family. And I'm constantly looking to improve. Like an athlete, I'm always training. So I do dailies. My work is done between a half hour and to an hour, I'm done. I don't even really look at the charts. I don't care what's happening intraday. I have my stops in place. I have my entries, if where I'm looking to buy or sell something. Everything is all thought out. There's no point for me to watch the screen. So that's a kind of question that you need to figure out. What is your time constraints? What matches your personality? And again, I invite you. You can email me. We'll try to set up a time. We can chat. Do you place the initial stop at the 10-day low even though the ATR is above this? Well, if the ATR is above it, something's wrong. And really what I would be suggesting is there's no magic between a 20 and a 10. It could be a 25 and an 18. Again, everything has a trade-off. The lower the numbers, the more whipsaws you might have, but you're going to get in earlier. And then the vice versa is if you use, let's say, a larger time frame. And again, there's no magic to it because if you look, let's look at Apple. Did it matter if it was the 18th or 20th or 24th day? No, the thing moved. That's where you're going to make your money, is when things move. So there is no magic, but it sure as heck should be above the ATR. And also you can see what the parameters of your ATR. Like here, it could be a 5. It could be, there could be different attributes. It might be too sensitive. I'm not sure what your parameters are. The other super important thing is you want to trade with the trend. You want the MAC to be increasing if you're long and above 0. And if you're going short, you want it to be below 0 and going short. Look at this. Everything lines up. And if you want it to go short here, which you wouldn't because it wasn't the weakest stock, whatever, and people did short this and got their head handed to them, which happens, the MAC is going down, but it got negative here. And then this trade didn't work. Again, simple, robust concepts. The hardest thing you're going to find is I can easily teach anyone the rules. Simple. They're not hard. But don't think that that makes trading easy because it's very hard. It's not easy. The reason being we make it difficult. We have emotional baggage that we're worried about losing money or making money or all these things. So really, you have to accept the uncertainty. The only certainty of when we trade is uncertainty. And because everything is uncertain, you have to know exactly how much money are you willing to put up on the table. And if you don't know, and you don't know how many shares, you shouldn't even start trading. It's ridiculous. You're just giving your money away. This is what I talk about having a plan. And then the fact is you have to feel good about putting on a trade. Because where people will screw up over and over again is they try to second guess their systems. They try to second guess themselves and try to avoid losses. It's not going to happen. And that's why I do the mentoring, because what I ask the students, I say, okay, great. Let's talk about what you're doing. Let's critique it together. Let's put your rules together, your plan together, and then I want to make sure you're following it. And I be very upfront with you. I've had traders that they didn't even follow their own rules. So I was kind of tough. I said, so why are you doing this? It's not going to work. Again, trading's not easy. Let's see if there's any last questions, and then I'm hitting it. Okay, I greatly appreciate everyone's time. I invite you, if you have questions, you can email me. I've been helped. I had mentors. You can email me. I'm here to help you. And if you want this document, I can send it to you. And it's basically proving the facts. What I'm saying is money can be compounded over long periods of time. There is no magic. And if these guys can do it, and I can do it, you can do it also. Again, thank you for your time. Greatly appreciate it.